All right, welcome to the REI Diamond Show. Camilla, how you doing today?
I'm doing great, Daniel. Thank you so much for having me on.
Yeah, absolutely. I know a little bit about you, but for anybody who may not recognize the name, could you kind of go through, we'll call it the origination story. What did you do before real estate? How'd you find real estate? And then how did real estate investing evolve into steady stream investments in your business model today?
Yes, perfect. So I started real estate investing when I was quite young. I got my first property at the age of 22, and it was a house hack that we did. And we didn't know about it. It wasn't like a cool term back then, house hacking. But we just figured, we want to own our own place, but we don't have enough money to own our own place, basically. And so we bought a home that had a basement apartment in it, and we rented it out. And it worked out perfect. We only paid about $100 a month in rent to live there, and even have a pool in the backyard. It was so cool.
Nice.
And that's when I really started thinking, okay, there's something to this real estate thing, and let's see what else we can do. And so started reading a whole bunch of books and trying to figure out what else we could do in real estate. From there, we tried the live and flip method where you buy a fixer upper and you move in because you can get really great financing. There's hardly any, you don't have to put much money down, and it's the best financing, right? And then you live in a construction mess for a while and you fix it up and then move out and either rent or sell it at that time. And that's how we acquired a bunch of properties. So we did that for about 15 years. We did a small multi in there too, launched a property management company, in all of that. But about 15 years into the journey, I was, itching for something bigger. And I had always had owned an apartment complex on my vision board. And I distinctly remember I was in Atlanta at the time, and I'm riding the train to work, and I'm thinking, okay, it is time. You've got to figure out how to own an apartment complex. So I pulled up my phone, looked at my bank account, like, yeah, there's not much money in there to be able to buy an apartment complex. And I knew they costed millions of dollars. And I never bought anything in the $1 million range before, in my investing journey. And I was perplexed. Like, how in the world do you buy an apartment complex? Well, little did I know, you don't really buy it on your own, right? Most apartment complexes are bought as group investments. I was intrigued by that idea, but also worried because I was that kid in high school when a group project was announced, that I was like, no, because that means I'm gonna have to do all the work. And the other kids in the group were like, yes, Camilla's on my team. Yeah, I don't have to do anything, right? And group projects were just never went well for me. And so then I'm thinking, well, group investing, that's even higher stakes because that's my money and my time. And how's that going to go? And so it took a fair bit of mindset shift for me to be able to be comfortable in the partnership arena. Um, and then as I'm looking at apartment investing, I figured maybe the best step for me was to join a syndication, which is just fancy word for a group investing, and do that as a limited partner, meaning I'll just simply invest my money. So we had sold a couple of our single family properties, and so we took that money and we rolled it into a multifamily syndication. And I distinctly remember being freaked out about that too. Like, what? I'm just gonna like give over $50,000 to someone else, and just cross your fingers, close your eyes. Okay, I hope it goes well. I mean, I did some due diligence, right? It wasn't that willy nilly. Um, but it did feel a little bit nerve wracking. But after I transferred the money and got into the deal, I was looking at it and I'm like, wow, this is amazing, because the returns on this deal are better than some of the returns that I made on some of my single families. And I couldn't believe it. And that I didn't have to do any of the work. I didn't have to find it. I didn't have to negotiate it. I didn't have to use my muscles. I didn't have to use my brain, my time, my energy. I just simply made my money do the work instead of myself. And I was blown away. And I loved it so much. That's why I launched Steady Stream Investments, to teach other people the power of investing passively into a multifamily syndication. And so Steady Stream Investments is all about education. It's about educating people about how to get involved, how to especially the first time passive investor. I like to specialize in helping them get into a multifamily syndication. And for the first time, because I know it's nerve-wracking, like I remember when I did it, and so I like to teach others how to do it. And that's what I'm doing today.
Nice, nice. Like the progression, the full story there. So let's go back to 22. We're doing a house hack, and I hear you tell the story. And I remember I was 20, 21, 22, and one of my friends bought a house, $100,000 house probably. And I was like, man, I wish I could buy a house. And like, I didn't understand the 3% down financing. I had trouble holding a job for 2 years. I was kind of like, young and dumb and not as disciplined as perhaps I am today. So like my path wasn't like a lot of investors kind of sounds like you. It was nice, steady progression. We're building up the assets. The assets are growing in value. We're managing them. For me, I didn't really have that because I didn't have much to come from like a professional career. I was like a car sales guy that bounced around and stuff and was like not really bankable. So when I got into business in 2006, I talk about this to anybody who asks me the question like, well, how did you get to where you're at today? Well, I did it by becoming a source of deals. So I was going to vet more deals. I was going to make more offers and I was going to get contracts signed and I was going to be the source of deals that could then, assign a deal, make a little bit of money, fund the deal and flip the deal, make more money, maybe JV on a flip and have someone else do the work of the flip and make half of a lot more money than I would have made on like a wholesale deal. Or, and I am a real estate agent now, but I was not 15, 16 years ago when I got in. But even a real estate agent, like being the source of deals and like figuring out how to kind of get that rolling is so critical to my own success. But I want to highlight that what you did at 22 was something that I like did the math in my head but couldn't figure out how to get it put together, and it's like such a cool thing. Like, wow, $100 a month to live there. I think I was paying 750 to rent and like getting nothing for it. And then you fast forward a little bit. So you guys actually still have the property management business, or have you now decided that the rentals are all time to get rid of and solely on this?
Yeah, we've fully transitioned into large multifamily now. And so we sold off all of our single families and small multis, and now are just simply doing large multifamily.
Nice. What market was that in, Camilla?
So we moved around a lot. So we started out in northern Utah, is where we acquired the most of our properties, and then we moved to Indiana, and we acquired a couple properties in Indiana as well. Now we live in Texas, and our multifamily properties are in Arizona, where we also used to live. We just move all around the country, and so Arizona and Oklahoma is our latest acquisition.
Okay. And do you do anything else besides real estate these days?
I do. I still have a W-2 job. Yes. So
Okay.
I work in HR and supporting tech companies.
Nice. That's interesting. We are not I don't see many guests who do have the W-2. Everyone's so happy to go and quit. I think there's so much to be said for hanging on to it, being bankable, having that steady stream of income, even from the W-2. And I know we're working as we're pitching the passive thing, but there's a lot to be said to not have to rely on real estate investments to eat and have the investments be what they are, which is kind of investments. And you reach a certain point of capital that the capital's investments can replace the W-2 and cover all the bills every month. But I think I don't know, I guess I see a lot of people, probably myself included, who are like, burn the boats, quit. And we're like, we're done, we're moving on to something else. Do you guys syndicate and operate as the general partner, or are you guys kind of aligned with a general partner and select different investments with different general partners? What's the structure look like?
Yeah, so the structure is that I partner with lead sponsors. We call them lead sponsors. There's like typically one partner who is the lead of the whole deal, and my job is to find those and find the strong partners, vet the deals, and then bring them to my investors. I do join as a general partner, and because of my experience in property management, I help run the asset management on the deals as well after it closes. Um, and so that's kind of how the structure works for my company.
Okay. And about how long has it been since the transition to the larger multifamily's been?
About 2.5 years is
Okay.
for me. Yeah.
Nice. Why Phoenix, Arizona as a market? How did you select that? I imagine you looked at more than one apartment deal before you said, all right, Phoenix is going to be the winner.
Yes. Yeah, so Phoenix has really great market fundamentals. So when we're looking at a market and we're evaluating where are we going to invest, we look for a couple of things. So one is population growth. Is there, are people more people coming in than moving out? And Phoenix, Arizona has one of the highest population growth rates in the country. So it's constantly in the top 10. Second one is job growth, right? So we want to, how do you sustain population growth? By job growth. And so there are lots of companies coming in. Arizona is a very business friendly state. And so they always want more businesses coming in. And then number three, we're looking for strong fundamentals in what's the tenant base look like, and where are they working, how are they what are the jobs, the diversity of jobs, right? So we don't want to be in a market where everybody is relying on Amazon, for example. Maybe Amazon's the only company in that city, and what happens if Amazon dies? Well, okay, Amazon's never going to die. It's
Hey, you
taking
never
over the
know. Circuit
world.
City's gone. I mean, you got some
Right,
really
there you
big
go.
companies that are gone. Yeah,
Blockbuster, right?
correct.
So we have to be careful of that. So job diversification is also huge, and the Phoenix area has those three just very strong fundamentals, very strong markets, and the growth there is amazing. So I mean, it's funny, we always call it a hot market, and it like is literally a hot market. I lived there for 2 years and about died. But people love Phoenix. They love coming there. They love living there. And just a really fantastic market.
One of my mentors, not a real estate story, but one of my mentors, Dan Kennedy, would tell the story of, I think he's from Ohio originally. And it's cold in Ohio, and I'm in Chicago. So I look out the window at Lake Michigan here, and it's cold in the wintertime. And he said, it's funny, we're at these seminars and hear people always complaining and bitching about how cold it is here. And then this is Dan saying it, when Dan Kennedy, when he moved to Phoenix, Arizona for a while, he said the people at the seminars there, oh, you're so lucky. You get to be here in the wintertime and it's so nice and everything like that. And he said, if you go out on these things are called highways, and they have signs and they'll tell you how to get out of town. You're not a tree, you can actually move. But then he follows it up with, yeah, we're lucky, and everyone who moves to Arizona stays there, and it's great the first year, and then after a full year or two they move out because it's so hot.
I know some of the locals there that had been there 10 plus years. I would ask them like, man, how do you stay here? Because we were suffering. And they said, well, it took me 10 years to acclimate, but I like it. Okay, that's great. 10 years is great. But it is very, very nice in the winter for sure. And I think that's a lot of the appeal, is the winters are really nice.
Got it. And I grew up in Philadelphia, so Philly was more of a go to Florida. It's like Clearwater, Florida, and the
Hmm.
Philadelphia region, the East Coast, New York is kind of there. And then when I moved to Chicago, everyone's like, "Oh yeah, it's Arizona." So Arizona is kind of the Midwest
Yeah.
warm spot. I'm sure people go from Chicago to Florida too, but I never really heard people going from Philadelphia to Arizona. It's kind of like, guys, there's
No.
no water there. Like, what are you going there for?
We had a neighbor who was from New York. They spend their summers in New York and winters in Arizona.
Yeah,
But
look
if
at
you know
that.
if you study the migration reports, it's very clear migration happening from north to south, right? So the markets like Arizona, the Texas, the Florida, the Carolinas, those markets are all blowing up in terms of population growth and job growth as well, because people are preferring to be warm, I guess.
Yeah, that and probably the taxation structures of like our New York
Mhm.
State, Chicago, Illinois, the older the inventory there, it's definitely a different type of regulatory body when it comes to big businesses wanting to move there. On the flip side, I guess a Chicago affiliate in New York offers some of those big companies like a talent pool that's at this like
Yeah.
whole other level than places that don't have the large population growth. But we just went into Phoenix for single family deals ourselves. So we have one under contract so far, and we've done like
Nice.
a 186 in the Chicago and Atlanta and Philly where we're already at for the year. So it's like very small entry so far, very hot market, but 4.5 million people in Maricopa County. The growth rates are kind of
Mhm.
phenomenal. The appreciation rates are absolutely scary. Looking back over the last year or two, it's like who knows if it can continue or not. It probably will. It's probably becoming a mini California type of a market, if I had to guess. But yeah, exciting stuff. So let's talk returns, right? So apartment syndication deals, what can a passive private investor gives, 50, $100,000, and what kind of returns would somebody expect from that size investment?
Yeah, so I'll take the 100,000 example because it's easy math. But typically, when you think about returns, there's a couple of numbers that you want to keep in mind. So one of those numbers is what's your average annual return, right? And a lot of times that hovers between 17 and 18%. That includes the sale at the end. Another important number is what is your cash on cash, right? So, what is your cash on cash return going to be? So, if you put $100,000 in, the cash on cash return is, say, 10%. That means you're going to be getting $10,000 a year in cash, right? In distributions. That's cash you can live on, that's income that you can just use. And then at the end, you'll get an appreciation bump. So when it sells, so often the multifamily transactions, we like to keep them around 5 years. 5 years is a really great time to be able to go in and execute a business plan. And we always look for opportunities to add value to it. And you can add value to a property in several ways. One is by increasing the income, of course, and it's not always just raising rents, right? Like I'm not the kind of investor that's just looking for a quick let's raise the rents $200 and and kick out the tenants that are there. I'm looking for other more creative ways. Like could we increase the income by having reserved parking spaces, for example? It's one of the things that we did on a recent property. Tenants love that. They are more than happy to pay $10 a month to have a parking space right next to their apartment, right? Um, Pet rent, right? We can charge pet rent, and pet owners, they love their pets so much they're not going to get rid of them. They're happy to pay extra to be able to have their pets. Laundry facilities, etc. There's lots of different ways that you can add income, and then take a hard look at your expenses. So how can you reduce those expenses? And those are two really important ways to add value to a property. So the business plan takes, we do that about that takes about 1 to 2 years to execute on those main items, and sometimes there's renovating units that are involved in there, and you can raise the rents for that, because tenants are typically happy to pay another $50 a month to have a new kitchen, right? And then the other 3 years are just kind of given the property time to appreciate, right, and to for it to be to the rents to be able to rise a little bit, and for just everything to stabilize and the property to be good. Then at the end of that 5 years, we sell. It's an important number that we look at. Is called equity multiple. And the equity multiple means if I put in my $100,000, what will that turn into over the course of 5 years? The most recent one that we just closed on, our projections are about a 2x equity multiple, meaning your 100,000 goes in, and at the end of 5 years, after all is said and done, that 100,000 has turned into 200,000. So you've doubled your money in 5 years. And I think that's super powerful to be able to double your money in 5 years, in an investment like this. And so that's some of the numbers and things that you can expect from an investment.
Do you guys do accelerated depreciation on these on the way in? So what would a write off? I mean, on the one you just closed, 100,000 that somebody puts in. What's the K1 tax loss on a deal like that?
Yeah, so yes, of course, we definitely do accelerated depreciation, and that's just simply when you go in and you take a property and you say, well, carpet does only last like 5 years, and the doors are only going to last this many years. Instead of doing straight line depreciation over 30 years, you can accelerate and depreciate stuff early. And so typically that hovers around the 70% range, right? So if you put in $100,000, you can get anywhere from 60 to 70% of that back, written off as a tax loss due to the accelerated depreciation.
Yeah, and a quick disclaimer, neither of us are tax professionals and we're not giving tax
Right.
advice, legal advice. or investment advice. We're talking about our own experience, and you need to consult those proper professionals if need be.
Exactly. Thank you.
Cool. What are the type of deals you look for? Are we talking about like these were built in the 80s? Are they built in the 90s? Are they built in the 60s? Are we looking to renovate, a certain percentage of these units? Is there a preference for newer, less renovation properties? Like what's the buy box for you?
Yeah, for us, we're looking at properties that are 100 plus units, and we want them to be around the class C range in a class B neighborhood. And class C just simply means it's like working class housing, and it doesn't have all the bells and whistles. There's no super fancy amenities, but it's in a nice area where if we go in and we do some improvements to the property, that it could feel more like a class B property, a little bit nicer property. We could add some amenities into it as well. Um, we look for my team doesn't we avoid the heavy lift the model, meaning that you buy a property that's only 50% occupied, needs a ton of renovation. That's not our model. Our model is one that we are after cash flow. So we are trying to buy properties that are cash flowing from day one, because our my business and my partners, we prioritize cash flow over appreciation. If we were in the appreciation market, we'd be in California, right? And don't worry about cash flow, just get that big giant appreciation check at the end. But for us, we really prioritize the cash flowing properties, which is why we love the Oklahoma market and we love Arizona market as well, because they are very good, strong cash flowing plays. So that's really what we're looking for, is that cash flow. We're looking for some light value add, so we can go in and we can do a couple of things to the property to make it better, but not anything too heavy that's a little bit more risky.
Does that equate to investors receiving a check in month one because you avoid the heavy lift, or is it a month two, as opposed to, there's going to be a year of renovation before we stabilize and can do any distributions? Is that part of the consideration?
Yeah, that's what we shoot for, right? So we shoot for being able to give investors a distribution within that first quarter that we have acquired the property.
And is it quarterly distributions that you typically run?
Yeah.
Okay, makes sense. The the C to B class, I like that, and I can't remember where I heard it. If it may have been from another guest on the show, but they said that doing this similar model in a Class B in a Class A area sometimes creates issues where you're trying to reposition the Class A, which is maybe a little older, and get more of a Class A rent. So you're transitioning the Class B to more of a Class A, but some of the challenges that the tenant base that you end up with in a B plus turning into an A property can sometimes have trouble affording the rent, because if they're making the kind of money to afford the Class A's, they probably just went across town to the new construction building and had more of a preference toward that style to begin with. So the C to the B is kind of a little bit of a safer model, I guess. Correct?
Yes, yeah. And so I mean, my team, we're very conservative, right? Like we want to make sure that, Warren Buffett says rule number one, don't lose money, and rule number two, refer to rule number one, right? So that's what we do. Like we prioritize investor capital, and so that's why we look for those cash flowing properties that are just going to be that C to B type, nice middle of the road where they will always stay occupied, because if in a down market, everybody who lives in a class A property has to move down to B. B moves down to C. C moves down to D. D for
Hmm.
dump, right? And then in a booming market, the D's move up to C's, C's move to B's, B moves to A's, and so you have that sweet spot of those C's and those B's that really perform very well and stay occupied nicely, no matter what the economy looks like.
So, in the deals that you've closed and owned so far, what were the biggest risks that you considered when you were having a conversation with a passive investor? What did that conversation look like?
Yeah. So we talk about the risks all the time. I think the biggest risk for a passive investor is just the sponsor team, right? Who's the team? Do they have experience? How can they execute the business plan? Because you know you can get a glossy packet that says, "Ooh, you're going to make this much money in 5 years," but how do you know that you're actually going to make it, right? And so that's the another big risk is is the business plan solid? Is it conservative? Are there metrics in there that are basically ways to make sure that you have a pool of money. I'm trying to say a pool of money there to reserves. That's the word I'm looking for. Have those reserves just in case something goes wrong. And we know that there's always something that's going to go wrong. It's the nature of real estate, right? Things always go wrong, and you just have to be prepared to weather those storms and know how to do that. And so when I talk to passive investors about that, we talk about those risks. We talk about just making sure that you feel comfortable with the deal and with the people running the deal. The people running the deal are probably more important than the deal itself.
Nice. And part of why I always ask the guests, like, background, what did you do before? You said HR, which I'm trying to connect some dots here. And I'm like, okay, so you probably have conversations around hiring people, which is a really big risk for a business, and probably have spent this career in this other, this other career outside of real estate was spent gauging risk and selecting the right people. How important do you think that is for yourself to be able to select the right people now? We're talking property manager, the on-site property manager, we're talking contractors, we're talking sponsor teams. How important, if at all, does that skill set now transfer over into what you're doing now?
I think is crucial, right? So that skill set that I have, I mean, I've literally interviewed hundreds, maybe even thousands of people for jobs. I've been able to do that, and I always, from an HR perspective, the thing that I'm looking for is I ask three questions in any interview that I do, for corporate or for real estate. I ask about communication. How's your communication? Tell me about a time when you had a breakdown in communication and how you fixed it, because I want to know you know and if your answer is, oh, I've never had a breakdown in communication, you're Xed
You missed
immediately.
it. Yeah, you were the break.
Right, yeah, you're out, right? um, and then I want to know how you handle ambiguity. That's my second question, right? Tell me about a time that you faced an ambiguous situation, how you navigated it, because you're always going to be facing ambiguity. It's the nature of real estate, it's the nature of entrepreneurship. And I need to understand that, and then I need to understand your why, right? So why do you want to be involved in real estate? Why are you doing real estate? Why, as a property manager, why are you excited to get up in the morning and do your job? And if you're not excited to get up in the morning and do your job, maybe I need to find a different property manager who has passion, because the people who have passion behind what they do perform so much better and so much higher than those who are just kind of checking the boxes and just getting through their day. And so I look for things like that, and that's been very helpful in my success, to find the right partners, find the right sponsors, and to find the right all the right people that it takes to take down one of these big multifamily deals.
Are these the same three questions that you would ask in hiring somebody on behalf of your own or another company outside of real estate too? Is that where that
Yeah,
originates?
absolutely. Yeah.
Okay.
Those are over time. Those are the three that I've whittled down to be the most important. And the most important indicator of success, really, in any job, right? If they're interviewing for a technical position, of course, the tech team will evaluate their skills, right? Those skills. But for me, I'm looking for their emotional skills, their soft skills, their just where are they in their heads, because that's a huge indicator of whether they'll be successful or not.
How often in the real estate context are you having this interview process where the answer is a no? Like, what percentage, if you had to guess, is it 50-50 or not, 80-20, 80 or a pass? What would be the ratio of people that get accepted for whatever you're interviewing them for?
The pass rate.
Yeah, exactly.
That's a great question. And now I have to think through this. It's not super high, right? And I think a lot of that's because I approach things pretty carefully too. It's I want to make sure I understand you as a person, and how you go. But probably maybe 20%
Yeah,
pass.
that's where it probably should be. And I think of my own, my rental properties are not my main source of income. And so I have property managers in place, and I have not probably took the pass and dug in and spent the time evaluating 10 to get to the best two. my evaluation was probably 4 to get to 2. And these are good people that I have, and they adjust and they modify. There's probably better people out there, and I still have to dig in and kind of do my own qualifications there on that stuff. And I'm not saying I'm sloppy on my management, but I think that it's something that I pay more attention to. We got to be discarding 80% and paying a little closer attention as the number of units grows, and as the business to rents, et cetera, as all that grows. And me personally, as a manager of my managers, grows too. Um, but that is very, I think, good for people to hear that that's the pass rate is 80%. Is the pass rate the same now in the HR context when you're hiring for any company for any position? Is it also a 20% pass, or is it even less than that?
So it's probably similar. It's probably similar there. I think, in a corporate context, though, I don't see them until the very end. So I'm kind of the last person that they have to get through. So by the time they get to me, I'm not, I'll pass them along probably 80% of the time, rather than, it's opposite 20%
Okay.
in real estate for me right now. Because I know they've already been through a pretty hefty evaluation process, and so if they even get to me, they've got to be good. And then if there's like red flags about their communication, they're dealing with ambiguity, that's when I'll be like, yeah, no, we need to take a second look, find someone else.
Got it. Got it. So in the instances like in real estate, I mean, you're engaging a service, and it's probably pretty easy to kind of take a pass and just not call the property manager back again, or say you went in another direction. I'm curious, in the corporate hiring context, it's probably a little more difficult to say no in those 20% of the times, because other people have put in, 3 or 4 people have already put in so much work for you to now veto. That's kind of like there's a lot of pressure on the situation. But I'm curious how you tactfully take a pass on a candidate in a situation like that.
Yeah, so I mean, I have to get alignment with all the hiring managers and then the rest of the team who interviewed, right? And so we talk about it. I bring up my concerns, we talk through it, and understand. As far as the candidate perspective, I think it's always important to have good relationships. I never want anyone to feel that we've ghosted them, or that we just don't care about them. Like, it's important to for your brand always, like, corporate brand and my personal brand, Steady Stream Investments brand, be viewed in a positive light. And so I want to make sure that I'm very careful about the communication and relationships, and transparent and honest with the candidates. And I've gone to candidates before and I said, hey, looks like we're not going to be able to give you a job, but I wanted to give you some feedback. Like, here's how you can do better in your next interview. Here's some things that you could do. And one candidate in particular, I told him, don't like stick your hands behind your head and lean back like this during the interview.
Wow, wow, that's incredible.
So just some coaching, right? Because I'm all about coaching people to be their best, and so that's what we do. And then in the real estate context, right? If we interview a property management company per se, or a lender, right? We'll go through our last deal. I think we interviewed 10 lenders
Hmm.
before we found the one that we really wanted to work with, and we just make sure that we have the open and honest communication with them, and just say, hey, we like your product, we like what you're doing, but the product over here, they were able to give us a little bit better terms on this, and you can use it as negotiation, leverage and things like that. But just staying open and honest, and keeping those relationships in a good place will open other doors for you down the road.
So is that what it looked like for the lender when you take a pass? You're just kind of like, hey, these ones kind of went with the better one, so we're going in that direction right now.
Yeah,
Simple
we'll
as
give
that.
them, we'll give them a bunch more information. We'll talk to them more, and and just again keeping the door open, because the next deal they might be able to have the best one, and we don't want to burn any bridges there.
Yeah, that makes sense. I cringe at my own laziness. All right, we doing it? No, all right, let's get to it. I like the terms, and it's like, oh man, we didn't like this other thing. Now it's just, yeah, I do not have 10 lenders on my last deal that I interviewed and passed on. So that's a good sign if someone's investing money with you and the team, that you guys are putting in the actual work, because it's For me, it's probably lack of time, not laziness. But I think for some people out there, it might be laziness. It's a form of laziness, and it's just all right. We checked the box, cool. Let's move on to the next one. And now all of a sudden, I'm me metaphorically speaking, but I'm accepting maybe mediocre people on the team, and now all of a sudden that flashy brochure, the investment prospectus that I put out does not necessarily match uh, the returns because the mediocre execution there. So hats off on that.
Thank you.
So the only other thing I thought about was my fear of liquidity personally in investing in these type of deals. And I think you briefly touched on that early in our episode, but if that were an investor's hesitation, I'm not going to be able to get this money out in for 5 years, maybe even longer if the market is in the middle of another pandemic. When we go to sell it in 5 years, suddenly we're going to be in this big problem. And like a lot of us real estate investors were shocked to the core and still are appalled, but maybe not financially shocked. Most of us who are dealing with COVID 10 in situations where we can't even file evictions. And most of us, the stories I've heard on the show and throughout my contacts in the different markets, is that most tenants did the right thing, kept paying the rent, and a very small number did dig their heels in and take advantage of the situation and are staying there for a year, year and a half. I think we have like one house with a squatter that moved in and like we can't do anything. They just like broke into our house and we're stuck. But overall, we fared pretty well. But dealing with a passive investor's objection to being in the deal because of the non liquidity. So, like, how would an investor get comfortable with that, Camilla?
So when I talk to investors about that, I think one of the things that I like to understand is their full liquidity picture, right? Because if you only have $100,000 liquid in your account, I don't want you investing in my deal. Because now you've put yourself in a precarious position because you're right. This is not a liquid investment. It's not something that you can just simply get your $100,000 back. Now, whenever you want, right? If there are emergencies, like I always like to feel like I'm a generous person and helpful person, if there is some crazy family emergency 2 years in and you absolutely need your money, there might be a way to, bring in a different investor to replace your money that you're in. But for the most part, you should just plan on it being in that project for that time. So again, if your liquid position is not, I would say at least double what you are going to put into an investment. If you don't have at least like 50 to $100,000 in liquid reserves, just for yourself, for your safety, for your family, to take care of yourself in emergencies, then I would say don't invest yet. You're not ready, and wait until you are ready. And then as far as that liquidity goes, just remember this is an investment, right? Like you're not going to get returns like this with a liquid type investment. Like you need to think of it as you're sending your money away for 5 years to work so dang hard for you and double in value, and so that you can reap those rewards in the end. And so think about the end result, right? And just make sure your financial situation is stable before you go into an investment like this.
Yeah, and speaking of stable financial situations, am I right in assuming that this is limited to accredited investors? And maybe you could define that and talk about that and confirm or deny what the case is?
Yes. So typically, multifamily syndications, the majority of them are limited to accredited investors only. And if you haven't heard that term before, that simply means that you have one of two things. You either have $1 million in net worth, or your personal income exceeds $200,000 a year for 2 years in a row. Um, or $300,000 a year jointly with a spouse for 2 years in a row, right? So that qualifies you as an accredited investor. It's something to aspire to for sure, because all of a sudden your investment opportunities just really open up, and you can really accelerate your wealth building once you hit that status. Now, if you're not quite there, right? Don't stress, don't worry, don't beat yourself up and be like, man, I'm not worth a million. I'm not a millionaire yet. That's totally fine, right? We can help you get there. And we do have investments. In fact, the one we just closed this week in Oklahoma is one that's open for sophisticated investors as well. Now, a sophisticated investor is someone who doesn't quite hit that $1 million net worth or not quite at the $200,000 income. There's not a certain number for sophisticated investors to hit, but I like to think about it as, well, your net worth should be at least around 500,000. You should be making it, at least six figures to be able to invest. The other qualifications for a sophisticated investor is that you can prove that you know what you're doing, right? You can prove that you have investment experience. So if you have a couple of rental properties, right? Then you can prove that you have experience in investments. Now, if you just go to your financial planner and you give all your money to your financial planner and they invest it for you in mutual funds, that's not experience, right? That's just letting someone else do all the work. And the final requirement for sophisticated investor is that you have a personal relationship with a member of the general partnership. How do you define personal relationship? Well, it's not that, we hang out every Friday, right? It could be just simply that we've had a phone call and we've talked on the phone and we've gone through over your investment goals, your financial situation to make sure that you're qualified to and in a good spot to be able to invest. So, if you feel like you're in that pool and you're like not quite there at the credit status to be able to do everything, you can reach out to me and we can have this conversation and I can talk you through what the different ways are to be able to invest as a sophisticated investor, because there's definitely deals out there. They're just harder to find.
Yeah, good, great stuff. Perfect definitions there. I remember not being an accredited investor myself. It does not feel like that long ago for me personally. And like knowing where I came from, history, background, alcoholism, drug addiction, like almost destitute. And then to be like standing here today, like you can become an accredited investor. And to your point, being setting it as an aspiration and as an intention, and then going to work for me, sourcing as many deals as I could possibly source was definitely a big key to that. But there's for sure a path to get to becoming accredited and then shooing into these kind of a deal. So, all right, we are just about at the top of the episode here, Camilla. So I'm curious, book recommendations. They don't necessarily have to be specific to real estate and passive investing. If they were inspirational to you, if you wouldn't mind sharing one or two of those for the listeners.
Sure, I'd be happy to. I'm gonna pull out. Oh, okay. I don't know where it went. There was one I read as a teenager, actually, that is still influential in my life today. And it's called "Getting Comfort Outside Your Comfort Zone," and it was so influential that just I always think about comfort zones all the time, and think about here I am in my little comfort zone, and if I stretch out of my comfort zone just a little, that's all you got to do, just a little bit, and try it. Now, okay, you've done it once, you've done it twice. Now that becomes comfortable. And it's just this ever expanding, ever evolving zone, right? Because right now I do large multifamily. 5 years ago I couldn't even fathom doing it, and it scared me to death to call a broker, and I was scared to talk to people about money and be like, well, will they even want to invest with me? And here I am today, educating and helping people, and it's like second nature. Like, yes, absolutely, this is a great idea for you to invest passively. It's going to set your family up for so much success. You're going to create this cool impact. So that was one that was really important to me. The second one, I do have it right here, is called Who Not How. And Who Not How is one I just recently read over the last year. And it's all about, if you want to grow and you have growth on your mind and you want, something bigger, something better, think about not how you're going to get it. Think about who in your life is going to help you get there. And it was so powerful for me, as I remember I talked to you about like group projects. I hated those. Well, now it's a complete mindset shift for me, because now I'm like, oh, I want to, I want to go buy a luxury short-term rental. Well, who can help me buy a luxury short-term rental, and who can help me manage it and run it, instead of just looking at my own
Hmm.
self and thinking, okay, well, how in the heck do I even figure out how to do this? It's finding the people around you. Super powerful book.
Nice, good stuff there. So for the crown jewel of wisdom, we're gonna take all the wisdom that you have now, and you get to decide what you can tell your 22-year-old self the day of closing on that first house hack.
So my 22-year-old self, it's a hard question because I'm actually very happy with the pace and sequence of my real estate investing. Of course, it could have gone faster, right? Like I could have gotten into multifamily earlier. I could have done a lot more properties in a year than I did before. But I think that you evolve as a person. But I would tell that 22-year-old self that you're worth it, right? You have what it takes to do really big things, and it's okay to step out and do those big things. And I think my 22-year-old self was worried to step out and be public about what I was doing. I was very reserved. I didn't want it to feel like I was bragging about, the investments that I was making and how they were going. And I kept it very hidden and private. And I think that 22-year-old self could have benefited from more who's instead of trying to do all the hows herself.
Nice. Well said. So if listeners want to get some more information about you, Steady Stream Investments, where should they go?
Yeah. So if you want to just jump to my website, steadystreaminvestments.com, I have a free course on there that's called Passive Investing Made Easy. Like I said, I'm all about educating the first time passive investor how to get involved into a syndication. And that course actually includes a 10-year plan as well. So if you want to set yourself up for some pretty awesome success, it's going to go through a 10-year plan of what you need to do to be able to get there and have a pretty nice net worth at the end.
Nice. All right, I had a blast. I got a ton of good information, a lot of stuff that's not even real estate related, but powerful for me personally. So I thank you. I thank you for coming on the show, Camilla. It's been a good time.
You're welcome. Thanks so much, Daniel.